It's Thursday. Let's talk about that first hour trading and start with Apple. Here you see it in the pre-market. Apple makes a move to the downside in sympathy with the rest of the market. And then we see this slow, steady climb up into what looks like it's going to be a pop on the open. And in fact, that's what it turns out to be. So in the pre-market, we had program numbers anticipated 117.31, 117.97, 18.35, and 19.03. It made very smooth transitions through those numbers. The next layer we had established 119.80. Up above that, O spot 23, O spot 54, O spot 75, and O spot 99. So at the opening bell, we were ready to go. And as you can see here, things came together pretty quickly. Here it is, Apple right off the opening bell. You can see that 118.35 level that we identified as a program area. That did in fact work as an inflection. We're starting to catch these the same way that we did when Apple was trading in the $400 to $500 range. That was sort of the sweet spot for it. It's very rare that you get a stock trading at $500 on penny spreads. Apple was the one. Today, it's trading very much in the same patterns and on the same programs as it was back when it had a higher price. So when we had that 1835 inflection tagged on the open, talked about that before the market opened in the first hour trading pit, of course, in our war room. 11835 got you in. 11787, a violation of that pivot line down below, would have taken us out. That would have been a double violation program at 11797. S2 down at 117.87. Our target on that first trade, 119.80. So, you know, when you box these things up, when you put that bracket order together and you have it exiting at the next level, nothing you can do. You're going to get taken out. And when you see this kind of a thing up here where the stock just keeps moving without you, you can't let that get into your psychology. Trading's always like that, right? There's always more money that you could have made, or you could have avoided some loss if you would have done something differently. This is about what is, not what could have been. So if you want to reinforce your psychology, if you want to reinforce good behavior, then what you do is set yourself up to succeed by saying success is measured by whether or not I followed my plan, I did what I said I was going to do. That's always going to be the best way to stay on top of your game. 120.53, that was major overhead resistance. We identified that in the room. I should say Goran brought that to our attention. Lots of good input from you guys today, by the way. 120.53 was the level for the short sale then. Shorted it down to 119.53. That's essentially a repeat performance of programs that hit this thing yesterday. That's what we're looking for, is that order flow that's going to push it back into a range. And then we had the opportunity here to get a fib study on this. And if we look at it, you can see here that that's a rough drawing, of course, but there's a lot of confluence down here at this 119.11 level. And waiting for that is tough. It's not always easy to sit at the machine and you know, program these things up and just let them go. And you see all sorts of other stuff happening. And I could have had that, would have had that, should have had that, right? Coulda, woulda, shoulda, the worst three words in a trader's vocabulary. But if you waited and you got it down at that 119.05 or 119.11 print in the case of the fib retracement, you had confluence. You also had confluence over here with the volume by price data. So this told us that everything was in place for a recapture of the move between 119.05 or 119.11 and 120.53. So lots of good opportunities for profit this morning in Apple. And, you know, I think that if you manage to keep your focus on keeping the trades to a minimum, you don't want to have, you know, 15, 20, 50, 70, 100 trades, you know, whatever some people are doing on this thing over the course of the day. Very carefully, very methodically plan exactly where it is that you're going to want to enter. Know why you're going to do it. There's a confluence there that indicates program trades are going to hit it. And then it's really putting probability on your side. And as long as probability is on your side with this thing, it usually tends to work out. It's when you misread the probability that you get into trouble. One of my signature trades, that Baltimore Chop 2 standard deviation opening gap reversion trade, is starting to come into its own again. We're in earnings season. Earnings season's when this thing really blossoms. Today's triggers were not based on earnings, but they were definitely based on gaps that were in the news on the S&P 500. Again, we've got a great scanner at traderinsight.com that goes through and combs and makes sure that the gaps we're looking at are only the ones that have a statistically reliable probability of making a move, a reversion move back down towards that mean. It's based on the volatility. We know that volatility is mean reverting. We know that it's very predictable in terms of what's going to happen over the first half hour or so of trading. We're never trying to predict out beyond that first half hour. Half hour is the drop dead point for any new entries on this particular strategy. Let's take a look at what happened with the trades today. So here it is again. This is our gap scanner. It's been doing an amazing job of parsing through a ton of data and picking just those symbols that are going to wind up being the best opportunities for reversion trades. You guys who have been through the boot camp or been through the 2SD opening gap mastery class, you know how to program this kind of a formula up. This thing goes and does it for you, of course. So in this case, we had PGR and VRTX over here. And you can see that we also had AKAM. So Akamai also scanned up this morning. That one didn't wind up looking like a great opportunity once we had the chart in front of us. So we passed on that one. But we did go and take trades in PGR and VRTX in the war room this morning. Let's talk about those trades. Here it is, Progressive. PGR, this one was a little bit iffy when it first set up because you got down below S2 and didn't gap any further. So when a stock has gaps that don't look like they're that significant, the thing to do is bump out and look at the daily chart. Is it really obvious that this is 2 standard deviations of what we would anticipate in terms of normal volatility? In the case of this particular stock, it was. So the daily chart showed you that this is a big move away from what it is that you're normally doing during a trading session. The gap below S2, that gives you very little room in terms of where this one opened to a profit. So it opens down low and it winds up getting up high into the range. There's nothing here that says that a second bar is going to have room for profit because it's going to slam right into that floor trader pivot line. But then the move up to 98.09 in the first bar and that shallow second bar, they form what I call that backdoor slider setup. And then once it gets up above there, 98.09 becomes our entry price. We're not worried about that pivot getting in our way. And then we were talking about that 98.80 level and getting out right at that next pivot line. That turned out to be a good plan. It was also kind of obvious that that was going to be what happened based on, you know, the expansion ratio here got you right into 98.89 for 138.2% expansion on that original move. So really nice setup, very good statistical trade. This one is one for the books. Next you had Vertex. This looked like it was going to be a 1, 2, 3. You know, it was going to be a real nice stair-step progression down to lower highs that were going to give us a solid entry price. 230.74 wound up being the deepest high in our opening gap. So at first it didn't look like there was a whole lot of room for profit because when you're looking at this chart, it just doesn't appear that there's that much space between that entry line and where your target's going to be. That's because visually the chart is very misleading. It doesn't look like a lot of range when in fact it is $1.23 per share target. And we see that it got right up there, right? You always want to target open, low, high, close, something significant in the first bar of trading. Usually you're hoping that there's some sort of significant volume by price action out here. In this case, there wasn't. We were just using the price in the bar as the target and had a very tight stop down here at 230.03, right below this volume by price threshold. That told us if we reversed back into that portion of the chart, we were thinking it would wind up back down in here somewhere, and that's not something we wanted to be a part of. So really nice setup in VRTX this morning. Those trades, real good examples of textbook setups. So those are exactly the way that you saw them in the Income Trading Academy. Those are exactly the way that you've seen them in the Baltimore Chop Mastery class, in the Volatility Band Mastery class. But remember, part of boot camp was also going through and analyzing to see if there's sort of trades within trades. You get a day like today, big gap lower, all the stocks on your trading plans are gapping lower. You know, is it time to just call it quits and, you know, come back tomorrow? Or can you go and find examples of institutional order flow that's still moving a stock in the direction that you expected it to go, maybe just from a lower price? That's what I want to talk about next. So GTLS, this is our only XRV today. We did a bunch of analysis. We figure out where the institutional trading activity is. We isolate those stocks that have these big institutionally based moves and what happens in the morning market gaps lower. And, you know, we wind up way down in the range again. And, you know, our trigger price was up above the high of yesterday's trading. But a few things happened today that told us we might get a run once again up into the top of the range. You know, first off, take a look at where it gapped to. So this gaps down and comes right down to the level that provided support yesterday at 80.88, and then gave this big run up into yesterday's closing range. So that's why this morning, I suggested in the first hour trading pit that on this reversal back up through the floor trader pivot that we might want to go long and then just put a stop right on the other side of the pivot. And in fact, this one worked out beautifully. So this got us up right into yesterday's highs. We expected to see resistance there, but we had a good question in the room about timing the exits. So you asked whether or not a moving average crossover, a 3-period simple moving average, and an 8-period maybe would be a good way to time an exit. It turns out it is. It's a pretty good representation of what I would normally call a parabolic support and resistance study. So a lot of times what I've done in the past is pulled these parabolic SARs on a big parabolic move like this, and then you just get taken out of the trade because the parabola slams into the price action, and that's sort of an arbitrary way to get you out. This morning, the question was, can you use a 3 and an 8, use the crossover as the exit criteria, and let me show you what that looked like. I've expanded the data here a little bit so that it's easier to see what we are looking at. And then, of course, in Realtek, very, very easy to just go through and plot your moving averages. So in this case, the question was, can you use a 3-period? So we'll use the 3-period. We'll give the faster representation to it. We'll make that a green bar. And then we'll add an 8-period as well. And that we are going to make our slower moving average and show you what that looks like. So as you plot these, right, what you see is the 3-period comes and it moves back down through that 8-period moving average. The nice thing here is that the 3 really represents a flattening and a reversal right around the same point that parabolic SAR would. So, does it get you out of the trade as quickly as our normal criterion do? No, it does not, because the reversal of 2 closing prices in this case would get you out just about at this 3-period moving average violation. So that's why, in response to the question today, I said, if you use these MAs on these things, sometimes it's nice to just give yourself the tighter moving average and use the crossover of price instead of the crossover of averages as your cue to get out, especially when you see something like this that's going parabolic on the move. One more trade to talk about, and then I'm going to let you folks go. But this was an interesting one this morning, and it comes from the scalper plan. Those are our secondaries, as all of you know, and they really play out very, very nicely, especially when we get nice market volatility. So what you're looking at here, the NASDAQ scalper trading plan from last night. Again, this is all based on program trading numbers that we're expecting to see in the morning. You see that we've got Netflix sort of bracketed up here for a move from 549.77 down to 546.79, down to 545.15, down to 542.07. Now look at the way these plotted out in the intraday trading on Thursday, and you can see 549.77. We had price move up there twice at the open and do exactly that inverted check mark kind of a setup that we're expecting. First go around 549.77 got us right down to 546.79. That was a great trade. That's $3, right, on Netflix. $3 per share traded. The next time that we called it live was actually Julie spotted it coming up. So it was traveling up, it was moving higher, it was getting up above that 549.77 level, and look at what happened, right? It got down to 546.79. Then it gave us another opportunity for an entry, 546.79 down to 545.15. And you'll recall in the war room, we were looking for that 542.07 print, and we actually got taken out at 545.15 on that trade, but that is nothing to complain about. So these programs came together, right? Always keep in mind the psychology that's behind this stuff. Always keep in mind your psychology. If the spreads are too big, don't take the trade. If the spreads are really bothering you, make sure that you're going in. If you're going to short it at the ask. Don't go hitting bids, because if the spread's 40 or 50 cents and you're immediately going to be underwater $500 because you went and hit a bid or you lifted an offer, then that puts you in the position of psychological discomfort, which is the worst thing you can have when you're trading. When you're working on a trade, you never want to second guess the strategy based on how you feel. You always want to be able to go in with the courage of your convictions, and you want to be able to make sure that the way you get into the trade isn't something that sets you up for an immediate failure. Never want to chase, always want to trap. We are trappers, not hunters. That's been said a million times, and you know that over time, this is the proper way to approach trading the markets. All right, I hope you had a great trading day today and an even better one on deck for tomorrow. I am out of here. Have a great night, you guys.